Good evening, everyone. Thank you so much for tuning into Money Control. This is Markets Weekly. I'm Karunya Rao. What a week has it been? But the good news here is that we've managed to end on a positive note. In fact, Nifty has posted positive gains after a gap of 5 straight weeks. We've been on a streak of decline back to back, and finally we've been managed to pair that. Nifty this week has closed 3% higher and almost 3% gains coming in for the Sensex as well. The big outlier this week definitely was the metal name, but on the flip side, you had Nifty IT, which was still down despite some uptake that we've seen momentarily during the course of the week. Let's bring on board our guest for the day. It's Gautam Duggad from Motilal Oswal Financial Services, who will talk to us about what is going on in the markets. Our retail investors are very confused, Gautam. One day the market tanks, the next day you see a phenomenal bounce back, and that's typically been the trend for the last actually more than 1 week now. Just to put things in perspective, can you tell us what is going on in the market?
Yeah, hi, good afternoon. Thanks for having me. I think, Karuna, the important factor right now, which is driving the market, is the macro sort of headwinds. When the year began, we had a view that it's going to be difficult to make money in the calendar year 2022, given that the starting valuations itself were quite expensive. We were at 18,000 in October. And even if you were to assume that 1,000 rupees of EPS for FY24 is delivered, you were trading at 18 times 2.5 year forward, which was expensive by any stretch of imagination. So our view at that point of time, before this whole Russia-Ukraine began in January 22, was that it's going to be a difficult proposition to make money after 2 very good years of returns. Having said that, things changed after February, and now with crude at 110 or 115, and Fed increasing rates, RBI joining the party, liquidity tightening, and it's expected to continue to remain very volatile. So both macro and the global scenario has turned completely, and therefore, with valuations not completely in your favor, it's going to remain extremely volatile in our view, and market is going to keep reacting to the news flows which unfold as we move forward. The only silver lining amidst all this, challenging scenario is that the corporate earnings has been extremely strong. We are about to end FY22 with almost 35% earnings growth, which is virtually the same number with which we began the year. So despite all the mayhem that we have seen at the beginning of the year, when the financial year began, there was second wave, third wave of COVID, then Russia, Ukraine, semiconductor related problems. So despite all these headwinds, we are ending the year with a 35% kind of an earnings growth, which is very solid and highest since FY04. So that has kept the markets relatively in a better shape when you compare India in the context of global markets. So YTD, if you look at India's performance, it is amongst the top quartile performer, despite all the problems that we have seen. And this is despite $21-22 billion FI saving that we have seen after October. So all said and done, when we look at India, in an absolute sense, yes, we are down about 13% from the top in October, but we have done far better than the global markets. And in a way, I think this correction also offers you an opportunity to get into the stocks which you always wanted to get in, but the valuations were not in your favor.
So for those who want to use this opportunity to buy the stocks that they perhaps missed out on when the markets were soaring 6 months ago, how should they go about selecting these companies? Should they go by the stock performance, the ones which have cooled off a bit? Should they look at valuations? I mean, for a retail investor, there is lots to sort of absorb, lots to digest, lots of research to do as well. So what is a good point to start?
So I think, Arun, a good point to start always, irrespective of the market situation, is how is the earnings visibility for the company or the sector that you're trying to evaluate and get into. So it doesn't matter if the stock is down 20% or 30% from the top, because when the market's correct, it doesn't care how far it is down from the top. If the fundamentals have changed, then the past reference of stock price or market cap has no meaning, because that basically means that if your earnings profile has changed, if your earnings visibility has changed, and there is far more risk on the downside to the earnings, then the past price doesn't matter. So at any given point of time, when you are evaluating a sector or a stock on a bottom-up basis, I would think the first and foremost factor to look at is earnings visibility. Second, given that we are in a very volatile and a violent macro scenario, it is important that the stock that you're trying to get into has a very strong balance sheet. By that, what I essentially mean is it should not be leveraged significantly. Second, the cash flow characteristics matters a lot in a volatile and a disruptive macro environment. The first to get punished in this kind of an environment will always be companies with a weak cash flow matrices. So the company has to have a very strong balance sheet slash cash flow characteristics. And then third, the valuation. The valuation should not be out of whack. So basically, if you're flying on stories and narratives, I don't think in this kind of a scenario, when momentum has completely changed, those kind of picks will do well. So you have to go back to your basic fundamentals: earnings, cash flow, balance sheet, and visibility of growth. And of course, all said and done, the last but not the least is always the management quality. I would definitely go one step ahead and say that when you're trying to invest into deep cyclicals now, you have to be doubly cautious, because the cyclicals have done exceedingly well in the last 2 years, the likes of commodities, the likes of metals. So, sectors where you already made a lot of money and sectors which are deep cyclicals, you have to be extra cautious there.
Which pockets are you liking right now? Most companies have already delivered their FY22 and Q4 results. So any outliers in terms of themes, in terms of sectors that look attractive right now because fundamentals intact, earnings are intact, but the stocks have come off, so it's perhaps a good time to buy?
So there are two sectors which come to my mind, and those two sectors are where we have the highest overweight stance in our own model portfolio. Number one is Indian IT. I think the large cap IT specifically, mid cap IT, we are not yet very sanguine. We've been bearish there for last 1 year, but large cap IT is what attracts attention. Given that the stocks have corrected 25 to 30%, even in large cap IT, valuations are very very reasonable now, and these are the companies where demand visibility for the next 2 years look extremely strong. Notwithstanding the fact that there is a lot of noise which is coming on US recession and potential slowdown in US tech spending. We think that the Indian IT cater to a very different segment of the US market and European market as well, where the spends that our companies benefit from are not so discretionary in nature. Second, the balance sheet and cash flow characteristics of Indian IT is the best, among the best, if not the best. You look at the ROEs, you look at the free cash flow conversion and the payout ratios, they all have seen significant improvement over the last 5-6 years. You're essentially talking about companies with 80-90% payout ratios, 100-110% free cash flow conversion, and 13 to 14% growth available at 18 to 23, 24 times 1 year forward P. So this is the first sector where we will obviously deploy money if we had to deploy the capital. Second, where we are, of course, IT remains our single largest overweight, as I said, at about 300 basis point of overweight position, but entirely into large cap. The second sector, which has disappointed, however, the fundamentals have strengthened in the last 3 years, is financials. Of course, it has borne the brunt of heavy FI selling in the last 6-7 months. But the large cap banking and financials are looking very, very attractive when you compare it on a metric of valuations, earnings, and of course the balance sheet strength. If you look at the large cap banks, whether it is private or PSU like SBI, then what you have seen essentially in the last 3 years is the profitability has improved significantly. Asset quality has been cleaned up. The balance sheets are as clean as it can be. I mean, we've seen pretty good comments coming in from the banking sector corporates, where they've said that the quality of balance sheet that you're seeing in banking sector today is the best in the last 3-4 decades. So if you look at it from a numbers perspective, 5 years back or 4 years back, FY18, when the banking asset quality cycle peaked and the credit cost peaked, the profits of Nifty companies belonging to the BFSI category was about 45,000 crores. And the same 10 companies belonging to BFSI category, which are present in Nifty today, are delivering a profits of 1.5 trillion today. So profits have gone up almost 3.5x in a matter of 4 years. And next year also, we are expecting about 20 to 25% growth in the BFSI sector profit. And the fact that stocks have gone nowhere in the last 2.5 years essentially means that the valuations have become far more attractive. And the third sector, which I want to point out, where while valuations may not be absolutely cheap, but it has undergone a severe time correction in the last 2.5 years, which is the consumer staples. So, likes of Lever, Britannia, their stock prices are absolutely flat for last 2 to 3 years. In fact, 4 years in the case of Britannia. And of course, there are concerns. There is a slowdown in volume, rural consumption slowdown, and input costs have inflated a lot. So you may not make money in the next 6 months, but clearly the relative price value equation has now shifted, to my mind, in favor of reward as far as large cap staples is concerned. And I'm not repeating our usual preferences for discretionary names like Titan, which has been our top idea for 7 years into the running now.
But let's talk about the big picture. You were talking about how India is better placed than many of these global markets. But just this week, we saw key indices on Wall Street come very close to entering the bear market territory. Just last evening, S&P 500 was just short of entering a bear market phase. It's down almost 19% from its all-time highs that it made. So will India continue to outperform and continue to be relatively better placed, or do you see any fears of, maybe with the lag effect, India could also witness some kind of, more pain and more selling?
So, Karna, I think we cannot remain insulated from the global equity backdrop. It's quite possible and conceivable that we might also correct, right? But these are things which you cannot time. If you look at YTD performance, we are obviously standing out. And why are we standing out? It's because of the strength of the corporate earnings that we have seen. For 10 years in a row, FY10 to FY20, the corporate earnings disappointed and were muted. We had seen just about 6.5% earnings CAGR for that 10-year period. Nifty gave you just about 8.5% return, which broadly matched with the underlying corporate earnings momentum. But now in the last 2 years, corporate earnings are up about 60%. 20% in FY21 and roughly 35 to 40% in FY22. Markets have also given you about 55% return. So the moment corporate earnings started delivering, the markets also shifted its momentum. So what happens in the future? While this sounds too cliche, but this is a fact that the forward returns will obviously be a function of how the corporate earnings shapes up. And in the short term, obviously, it will be a function of sentiment, it will be a function of liquidity, as well as the flows that we are getting. So far, the redeeming feature has been, despite $21 billion of selling that I mentioned from October to April, we've seen almost equivalent buying from the domestic side. So retail flows have been extremely strong. We all have been hearing about the strength in the monthly SIP book. So while in the short term, you will obviously be hostage to the global backdrop and global sentiment, I think if corporate earnings do not see much deterioration, you would see an equally sharp pullback too. The important caveat that I want to bring in here is that in the mid cap and small cap segment, where we've had a very cautious stance now almost 1 year into the running, we still think that the large caps can continue to outperform the mid cap and small cap. I mean, if you look at mid cap and small cap indices and compare them versus the December 17 cyclical peak, while the Nifty is up 50% from the December 17 cyclical peak, the mid cap index is up just about 28%, and small cap index is now just flat. So 5 years from December 7, almost 5 years actually, December 17 to May 22, small cap index has not given any return. Of course, you will always find some bottom up stock idea which would have done well. But at an index level, this Nifty NSE small cap 100 index has gone nowhere for 5 years now. And I think in an environment where rates are going up, liquidity is tightening, and there are so many headwinds ahead on input cost, demand slowdown, rural consumption slowdown, I would want to be placed more towards, or rather more biased towards large cap versus a mid cap or a small cap index.
Okay. So, I was just seeing a question that's being posted live on our YouTube feed as well. One of our viewers is asking us if they should invest in gold because the stock market is falling. But, my question to you would be overall about how investors should protect their portfolio in this kind of a market, because there's a risk of in every other asset class that you look at, whether it's commodities, precious metals, cryptocurrency, equity markets, of course, bond market. So talk to us about how one should sort of rejig or look at churning their portfolio at times like this.
So, Karuna, it's a fallacy to believe that you can protect your portfolio. right? Then we will all be gods, that we will only participate in the upside in the market, but we will protect our portfolio when the market's correct. That is not possible. That's not even practical. You have to enter into equity markets with the assumption that you will also lose money when the markets don't do well. So that is point number one. Point number two is, to the extent that you can, you have to stay away from companies where there is no fundamental earning support, where there is no cash flow support, right? In a bull market where the markets is in a very strong upward momentum, all sorts of stocks do well, whether they deliver earnings growth, whether they have genuine cash flows or not. But when the markets turn, you have to be extremely cautious about the names which you are getting into. And that's why at the beginning I mentioned that you have to be clear on the earnings visibility, the balance sheet strength, and the cash flow conversion of those profits, right? And then you have to hope that the companies that you have invested into, while they will correct when the markets go down, but when the markets come back, they will deliver you returns which are in line with the underlying earnings growth. Second, to your point on other asset classes, you've seen that even during the COVID times, all asset classes corrected. You couldn't hide anywhere. Bonds were also falling, gold also didn't do well, and real estate, we are all aware, last 7 8 years hardly there have been any returns, right? So the investors basically, religion is to diversify across asset classes, right? Irrespective of the fact that you are in a different kind of a market environment today, but they shouldn't lose sight of the fact that their asset allocation is taken care of, because different asset classes will perform at different points of time, right? So obviously, depending on one's risk profile, one can have a certain allocation toward gold, certain allocation towards bond. But then equally, one should be prepared that when equities do well, some of the other asset classes may not do well.
Right. Okay. You were mentioning about how you like large cap IT names vis-a-vis the mid cap IT stocks and IT companies. Is that a view that you have overall in the markets as well? Because the carnage has also had a massive effect on the broader markets. And at a time like this, would it be better off? Would one be better off to stick to large cap blue chip companies, or mid and small cap also look attractive after this cooling off that has happened?
So I don't think there has been any carnage in the market first to begin with. The Nifty is down from 18,400 to somewhere about 16,200, so about 12%. Of course, there has been a bigger correction in the broader markets. Your small cap index is down somewhere about 23 to 25% from the October peak. And that is always the case. When markets correct, mid cap, small cap falls more. And when markets go up, mid cap, small cap will obviously tend to outperform the Nifty. As far as we are concerned, we've been very clear that one has to tilt the portfolio in favor of large cap. And this is a view we had for almost 12 months now. Of course, it didn't work out well in the first half of calendar year 21, but post October, this view started doing well. And I still believe that it makes sense to be more biased towards large cap, given that we haven't seen yet a single month of liquidity withdrawal, whether in US or in India. We have just seen one round of rate hike, right? So there is going to be multiple round of rate hikes, both globally as well as in India. And typically mid cap and small cap, how they behave in an environment when liquidity is being withdrawn, we all have forgotten for last 10 years. Because last 10 years, the liquidity has been abundant and interest rates were also virtually zero or negative also. So the environment has changed now, and therefore it makes sense to be more cautious when it comes to mid cap and small cap. Of course, you can always find a list of 10, 15 mid cap, small cap ideas on a bottoms up basis, which can and should do well if their earnings, if their sector is doing well. But in general, if you have to look at a big picture view from an index point of view, I would still think that it makes sense to be more biased towards the large cap right now.
Okay. One big learning that you would like to share with our viewers as well, because these are unprecedented times. There's a geopolitical conflict that's taking place. There are fears of recession that have been flagged off across large central banks across the world. Inflation, of course, we're all witnessing how it's likely to pan out. So talk to us about how one should adapt and make the most of a market like this, and any learnings that you'd like to share.
Sure. So, Kanya, one of the important learning of last 2 or 3 years is that do not get wedded to a particular sector. We all have seen there has been a massive sector rotation in the last 3 years. sectors which were completely forgotten and down in the dumps for almost 6 7 years. They made a huge comeback. Metals, oil and gas, utilities, power stocks were forgotten from 2012 to 2021, and kind of returns that we have seen in the last year and a half. Some of them have become multi-baggers, some of them have given 4x, 5x returns. So be very flexible when you are deploying your capital. Do not go by what has happened in the past and extrapolate that into the future. Second, another important learning is pay abundant attention to valuations, because the backdrop that we had for last 6 years with low interest rates and abundant liquidity, that has changed. So valuations will behave very differently in a changed environment as far as rates and liquidity is concerned. So do not assume that something which was trading at 80p, just giving an example, not mentioning any stock, and is now at 60p because the stock has fallen 30%, makes it cheap, right? Because maybe to begin with, that 80p itself was wrong, right? So when you are trying to compare valuations, when you are taking a 5 year average, do account for the fact that last 5 years were very unusual as far as liquidity and interest rates are concerned. And possibly we are now entering a more normalized scenario where the underlying cash flow, underlying earnings will matter far more for the valuations. And third and last, as I said, beyond the short term noise, in the long term, the markets will always converge with the underlying earnings growth. We have seen that between 2010 to 20, and already we have seen that from 2020 to 2022. So pay attention to earnings, because that is what is going to deliver the returns in the long term.
Any message for those who are still telling people to buy the dip, because there are a lot of memes, jokes being cracked at their expense, because every time you buy the dip, something goes wrong given the uncertainties in the markets right now. So would you recommend buying the dip, or you would recommend to take a cautious decision, carefully calculated, well researched, thoroughly checked, and then buy before you just jump onto something which just looks cheap?
See, it's simple, Karunya. If you don't buy the dip, then you will end up buying the up, and then you will be besetted with another problem after 2 3 years, that you will look back and regret that
Yeah.
I didn't buy when the stock corrected from 100. See, what is more important in my view is be absolutely clear as to what you want to buy and at what price you want to buy, and also be humble enough to know that at whatever price you buy, the price can fall further from there, right? It's never going to happen that you bought at a certain price and that price becomes the bottom. Because as they say, tops and bottoms are for fools and liars, right? So the only thing you can do as an investor is do abundant homework on what you are trying to buy, and pay special attention in this environment to the valuations that you are paying for that stock that you are trying to buy. Memes and all people will forget, because today you're making memes on people who are trying to buy the dip. Years, 2 years time, possibly, who knows, people will make memes on people who didn't buy the dip. So
So you're on the
markets will
side of
test
buy the dip
everyone's.
and not sell the rally.
Yeah, because see, I'm quite sanguine about the underlying corporate earnings environment, and the fact that after 10 years the corporate earnings cycle has changed, and the balance sheets on the corporate India, they are as strong as they've ever been. So in the short term, you will obviously see a lot of macro plus global noise, and if you can weather this storm and have a long term view, obviously 6 months, if you have a view, stay out of the market. If you have a 3 month view, stay out of the market. But if you have at least a 3 year view, then I think when you look back after 3 years, you will not regret having bought this dip. That's my view.
All right. I hope our viewers are taking note of that, Gautam. It's always very insightful and a lot of fun talking to you. Thank you so much for joining us on this very eventful week for the markets. Thanks once again. We'll touch base with you soon. And guys, thank you so much for tuning in. As always, on every Friday, 4 p.m. We'll be back next week. Until then, have a great weekend.